What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked number one on Wall Street in the All-America Institutional Investor Research Survey.
Michael, good to see you. You've been traveling this week, meeting with clients.
Yeah, happy Super Bowl Sunday, Stephen.
Yeah, exciting day.
Yeah, last week, man, a lot happened last week in the markets, and I feel like there's even more that happened because I was on the road last week. I was in Chicago all week, saw clients for a few days, and I was also there with my oldest daughter, who is a senior in high school, and in the college application process, she is applying to be a musical theater major, big into the arts, and man, what a process this thing is. Last week in Chicago, they had something called Unifieds, as the kids call it. And basically in the Palmer Hotel, I think must have been 50 or 60 different schools from around the country that all go there and for the kids to audition. So feels like there were thousands of kids there.
Wow.
So we were there all week. My daughter had about 16 different auditions with different schools. Quite stressful. I'm glad I'm not 17 years old, as much as I wish for youth. But yeah, so it was a lot going on there. But yeah, I saw clients during the middle of the week as the markets were getting pretty crazy. And we ended on a positive note, that's for sure. But yeah, lots to talk about.
College interviewing. Oh, how things have changed.
I still remember sitting with you at ISI when she was born in 2008 as the financial markets were melting down.
Unbelievable. Not exactly the same today, but midweek this week, you did have quite a few panics in the market with some of the moves in gold, Bitcoin, the Mag 7 software stocks. Definitely a little bit of a panic. Was that a big topic of conversation when you were meeting with clients this week?
Yeah, absolutely. Last week, if you spoke to investors, if you turn on some of the financial media, it seemed like markets were melting kind of thing. I don't know if there was a markets in turmoil CNBC episode last week, but when you look at the market, there was some continuation of a lot of weakness in the areas like software. Tech's been struggling generally for a few months now. And of course, everyone over the last 3 years has been pushed into the tech space. A lot of stuff that really has been getting hit recently is stuff that's been widely owned or crowded. And at the same time, though, if we look at other parts of the market, you're hitting all-time highs. I saw last week the equal-weighted S&P hit a new all-time high. Even on Thursday, or Wednesday or Thursday, which is one of the worst days, you had the Russell 1000 value at just sitting on an all-time high. Investors have to be careful of watching the S&P index and extrapolating what's going on, because just like we saw for 3 years in 23 and 24 and 25, where the index was rocketing higher, not all stocks were participating to the upside. And now we've had the opposite. And so you're getting some of these big cap tech stocks and AI related names that are just getting pummeled as questions continue to grow about disruption and debt fueled CapEx. But at the same time, we've had a pretty healthy and strong and sustainable rotation taking place really since October of last year.
Yeah, if you turned on the TV last week and looked at what they were talking about in markets, highlighting the big drawdowns you saw, you would not have known that underneath the surface, things like S&P 500 value were at all-time highs. There's definitely a shift, but it's a shift out of a lot of these names that had just been linchpins of portfolios for the last 3 years. So I think that's definitely caused some anxiety in investors watching their beloved stocks pull back.
Yeah, so the momentum trade, as they call it, was definitely an area that got hit the hardest. And this is a story we think is going to stick, not necessarily seeing downside in parts of the market, but more about the renewed opportunity set of investable options that we're starting to finally see after 3 years of a very K-shaped and bifurcated market. So maybe I'll give a quick background of how we see things through our lens of how we got here and why we're getting this rotation, why momentum is not only underperforming, but it's also starting to change. Bloomberg had an article last week highlighting how a little bit more than a third of the momentum basket are now value stocks, which tells you that value strategies have been working now for long enough to become part of the momentum trade. And so as I think it's basically started, this rotation started in October of last year. And what makes it different, because we've had 5 or 6 different head fakes over the last 3 years of small caps are starting to work and cyclical stocks are starting to outperform and tech stocks are underperforming. We've seen this before, but there's a big difference today in that this trade now is not happening on the back of lower rates, which is really what those other ones all had in common. We got a good inflation report or a good soft jobs report, or really anything that was going to bring down interest rates the last few years, usually led to about a 3 to 4 week rotation in the market, but then it just completely sputtered every single time. And I think the reason that it didn't sustain itself was because it was all from rates coming down, and really none of it was from better economic data or better earnings data. But now, after essentially 2 years of rising unemployment and 2 years of slowly falling interest rates on the long end, the short end, money growth picking up, oil prices falling, and all the new fiscal stimulus that's kicking in this year, we now are starting to see parts of the economy wake up that have essentially been asleep since 2022. And you're seeing it being reflected in the earnings data, where we've seen broad-based earnings improvement in terms of expectations. And that is what ultimately makes a rotation sustainable. So this is the first time we've seen a broadening market take place on the back of better macro data and better, broader earnings data. And I think that's why it's lasted this long, why it's been so powerful, and why you're seeing money start to leave the crowded trades of the past 3 years and move in. You could argue, in a perfect system, the S&Ps again back to all-time highs. The equal weighted is at an all-time high. You've had a lot of stocks down, but at the same time, we've had a lot of stocks up in the markets at a new high. So isn't that what a rotation is? If, again, assuming all the money stays in the market, goes from one place to another.
You bring up a good point there. There have been, over the last 3 years, periods where longer duration, AI, Mag 7, larger cap stocks have worked, most profitable, all of those things. You have had a week here or there, a month and a half, where more cyclical parts of the market worked. And you had these upswings and expectations of this is now the time, and you hope for different leadership. But none of them were on the back of changing economic trends, and they all fizzled out. And then now we are a couple months in to this leadership change, but it's a much different situation than we saw anytime in 23, 24, 25.
So we made a call back in late September. We finally made that broadening call for the first time after kicking and screaming and pushing back against that in 24 and most of 25 and certainly in 23. And so we made that based on, again, all of our forward-looking charts of the breadth of the macro backdrop and earnings pointing to a recovering in 2026. And we're seeing it. In the fourth quarter, we pointed to a lot of the housing data that started to improve. And you said hope. So you triggered the hope framework here. So let's talk about that. We had easing that took place in 24 and 25. Housing data started improving in 25. The MBA purchase index has been grinding higher over the last year. That hit a 3-year high or so about a week ago. And then in the month of January, every single regional PMI and national PMI that we follow was either up. Most of them were up. There were 2 that were flat. I got to think this is the best, broadest month of PMI breadth we've seen in a very long time. And there's only now 2 that are not in expansion. So the breadth of services and manufacturing PMIs, which is the O in our hope framework, has really materially gotten better in recent months. And we saw the ISM manufacturing report, new orders hit 57. The headline ISM hit 52.6. So, we haven't seen numbers above 50 often over the last few years. And so we got lower rates and easing, better housing data. Now we're seeing better orders data. This sounds like a soft landing.
And you've been seeing better profits too. You've seen small cap earnings and mid cap earnings accelerate. This is your hope framework, why we have these milestones to see that signal through the noise. And we're seeing that signal today.
And again, this is what is different today. And we think it's going to be sustained. We think we're going to see a lot of expansionary points there. And one of the things I would point out is that there's still a lot of people really worried about the labor data and employment. And I'll just say, we think the labor data will continue to remain pretty soft. We don't think, as we've been saying for a while, that we're going to see any kind of shock or really acceleration in unemployment. But it's good news, as we've been pointing out for the last couple of years, that we have soft employment data. In fact, last week we got a soft JOLTS data. We had claims that went up a little bit, and that helped get the 10-year back down to 420 from 430. And so keeping rates contained is a really important part of this current market rotation, because it was predicated on rates coming down, and higher rates, certainly a surprising spike in the long end, could certainly be something that disrupts the market and also disrupts the ability for the soft landing to continue to evolve. And so in that sense, it's good news as we see it. And this has been the case. We've been arguing for 2 years that soft employment data allows for housing orders and profits to start to broaden out. Again, that's generally how the hope cycle works. Don't worry about employment data. There's the key takeaway there. When you're seeing better housing, you don't need to look backwards.
I think it's a good point to bring up. Having the weak jobs data this week, while you were having some turmoil in some of these big names in the market, definitely caused some jitters and was a data point that a lot of people are pointing to of, is this foreshadowing something worse? So in your mind, the weak employment isn't a problem. It's helping to keep the economic train going.
Yeah, ironically, it's part of the fuel that is getting us to this better backdrop. And one of the things that was interesting about the market last week is that, again, it really wasn't that bad of a sell-off in the index. But again, you had a lot of stocks that were really hit hard, particularly in software. But what was interesting, as I was thinking about the potential for a deeper downturn in equities, this sell-off, it wasn't a macro-driven sell-off, which most sell-offs are. And what I mean by that, it's usually rates that are spiking, pushing equities down, or oil prices that are spiking, or the unemployment rate is spiking and the market's getting crushed, or something like tariffs, like we saw last year. Those are the usual catalysts for market 10% corrections or bear markets, spikes in interest rates, unemployment, or some kind of exogenous shock. This really wasn't any of that. This was really disruption, AI related concerns, and just those stocks happen to be very big. So they play a big role in the index. But at the same time, you really didn't see much credit spread widening, typical things you see when you get these macro-driven sell-offs. So I guess part of me, I wasn't that concerned, and I'm not that concerned, at least for, again, the stuff that we've been recommending since late September, the broadening trade, smaller caps, transportation, retail, financials, stuff that's going to benefit from this cyclical improvement that has clearly been strongly outperforming and even hitting all-time highs last week before Friday. So I thought that was an interesting nuance of this pullback. There wasn't any kind of specific thing outside of, again, just the concerns over CapEx and these companies having to raise more debt. The numbers are just gargantuan of how much they're going to be spending this year. I think the estimates from a year ago have more than doubled to what the current estimates are. So yeah, there's a lot of concern. In a way, we kind of had this perfect storm 3 years ago that started creating the bifurcating trade. You had AI just getting going at the same time where all the pain was starting to show up from the tightening cycle and the inflation shock of 22. So you saw earnings booming in AI and large cap growth stocks and falling apart everywhere else. And it seems like we're seeing the opposite now, where questions and concerns are growing in that AI space and the derivatives of it, and i.e. the disruption we're seeing being priced into software stocks at a time where you're starting to get some positive surprises in the economic and earnings data, and even some positive guidance in areas of the economy that people have ignored and forgotten about because they've been so weak for the last 3 years. So it's kind of this perfect unwind of the last 3 years, and you're seeing it in market multiples. The S&P's multiples come down a bit. The NASDAQ multiple, I think, was down about 4 points over the last couple of weeks, while the Russell 1000 value or the S&P 500 value is hitting new highs. So this rotation we've seen under the surface, why it's been so strong is because it's occurring on the back of better macro data, again, better PMIs, certainly was the case this month, better earnings data. The earnings of the Russell 2000, how they are changing, are outpacing that of the earnings expectations of the S&P 500. And again, that is the lifeblood of relative performance rotations. And then the kicker to that is that valuations are doing the same. You're getting multiple compression in large cap growth stocks because of all these questions and concerns. At the same time, you're getting multiple expansion in the areas that are starting to show some better data and surprising to the upside. So that, I think, explains to us why we've seen such a sharp period of volatility in the momentum trade, at least those stocks that are not in the value space, which is becoming a growing part of that momentum trade. And this could continue to be pretty violent in terms of this rotation, because again, there's been 3 years investors have all just gotten sucked into the same stuff because that's where the earnings were. But now there's an opportunity cost, you could argue, for just holding on to the top 10 stocks.
What you're seeing right now is people trading future growth, long duration growth, and speculation for today growth and earnings today, which hadn't been there for the last couple of years. You really saw no earnings growth in mid and small cap stocks for quite some time.
Here's a good example of that. You look at crypto and Bitcoin, which has been, I think, the worst performing area of the financial markets in the last several months, certainly from October when this rotation started. And again, is it a coincidence that Bitcoin peaked around the same time this market rotation started? I don't think so. And coin enthusiasts should pay attention to that. So Bitcoin and crypto is a infinite duration asset. There is no earnings. There is no dividend. There's no yield. There's no fair value. There's no pricing of that. And that's been the worst performing. Now, when we look at the equity market and say, what's been the best performing factors this year? It's dividend yield, which is about as short duration as it gets.
I'm glad you brought up Bitcoin because that has really been under pressure all year long.
Yeah, the volatility is crazy. It was up, I think, 10 or 12% on Friday. Yeah, I guess from my seat, when I look at Bitcoin and think of it as a risk-on, long-duration asset, those types of securities do well when risk is getting priced out of markets. And so what do I mean by that? When credit spreads are tightening, when market multiples are rising, which tend to happen together. And so we came into this year, and really, even if you go back to late last summer, we've been sitting at record low credit spreads for a really long time, reflecting that we've priced out most of the macro risk. If there was more macro risk priced into markets, you'd have wider credit spreads, and we don't. So an asset like Bitcoin or equities that are much longer duration or are not profitable, not a great risk reward, because you really have any fuel left in the credit spread compression tank, which has been a huge driver of a lot of the speculation and risk appetite over the last 3 years. Remember, we saw a big blowout in credit spreads during the 2022 market sell-off, and over the course of 2.5 years, that ground back to zero. Of course, we had the tariff sell-off last year, but investors now are very much focused on earnings. And are you going to deliver today and tomorrow? Not so much 5 years and 10 years. That's where a lot of the questions are being raised, which is why I think you're starting to see some multiple compression in those areas. So it's not a bearish case necessarily for that spot because the earnings are still great, but it really goes to over the next year, are there going to be more concerns and questions or less? And it's certainly on a relative basis, I think there's going to be a lot more questions and concerns at a time where other parts of the economy and market are starting to look better.
I think you bring up a good point there with earnings and expectations. They play such an enormous role. These more cyclical areas, value areas of the market, smaller caps, they don't need to grow more than the Mag 7. The expectation change is such a big driver. You were expecting 5, 10, you get 15. And while that may be less than the 20% numbers that some of these large cap growth stocks continue to put up and stably put up year after year, it's that expectation change.
Yes, I've told clients really simply, I'd rather own transport stocks than large cap tech stocks. And again, transport stocks are not going to have the earnings that these AI names have, but there's been upside surprise in that data and it's starting to improve. And it's all about that surprise. I like to say happiness equals outcome minus expectations. And we know which parts of the market have high expectations and we know which parts of the market have low expectations. And I think that's the low expectations area is where you are seeing some outperformance this year. And I think where you're going to see some upside surprises as the data roll in. So yeah, I think this is the beginning of a sustained rotation for the first time, really. And here's a nice play on words here, really since the economy reopened last time. And what I mean by that is the last major rotation took place into cyclicals and into value it began in November of 2020. Why? Because there was news that we had a vaccine for COVID and the economy was going to reopen. We've been in this K-shaped backdrop now for 3 years. And I think at least cyclically, things are going to start to broaden out rather than diverge or start to reopen again.
Great. Thank you, Michael. And we'll keep an eye on markets again this week.
All right. Have a good Super Bowl.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.